So, with the local market tumbling over 100 points today, how have risks changed for equity investors? Joining me with his expert analysis is Rudi Filapek-Vandyck, the editor of FNArena. How are you, mate?
I like the tone you take when you talk about FN.
Oh yeah, it's a good name.
It's like a movie.
Well, I think I'm trying to impersonate those big black commentators in basketball. FNArena.
Yes.
Okay, let's get back to more important things. You think that risk issues are changing?
Well, here's the thing, Peter. Earlier in the week, I thought, okay, let's talk about risks on Switzer, and then today we have 100 points off. So my hunch wasn't that far off.
No.
I think what I was trying to warn against is what chartists call a blow-off top. It's when the market makes its final run up and doesn't take anything into account, and all of a sudden the time.
You think we're in a blow-off top situation here? Yes or
well,
no?
we get a big warning here.
Okay.
We definitely have a big warning today, and I think that's a warning signal in itself, because
100 points fall today.
I think, well, it's not so much. The 100 points. Okay, it's a big fall, but I think what it shows is that, I'll put it another way, if the markets didn't have the impression they had the unconditional support from central bankers, I'm of the view that markets would be lower anyway.
Yeah, of course.
And what's happening right now is that you see that, and that's not a view I have, I think the Federal Reserve is trying to get complacency a little bit out of the market, which means they will deliberately give mixed messages and try to prepare markets as good as they can for the day that they will withdraw their support. Now that might not go smoothly, and I think what we see this week is that markets, because it's a sentiment thing, markets can get really spooked when granddaddy with the liquidity is maybe
the guy who owns the punch bowl takes it away.
Exactly.
Yeah.
And I think that's what we're seeing today. So that's in itself a warning for when the day arrives that actually might happen.
But Rudi, to explain to normal people out there who wonder why Bernanke's doing this highly risky play, is he not saying, look, I'm doing this because I want the US economy to really start to grow and be solid before I say, okay, it's now time for you to do this without me. So I'm going to pull it away. Now, it seems to me some people are rushing to say, he's going to taper, and he comes back and says, as he did last night, yeah, taper might happen, but it's not going to happen now, right? Is that the way he's playing the game?
I'm with you, but as I said, what they deliberately want to take out of the market is that complacency which we've seen over the past months, where investors basically, well, let's take a step.
With QE infinity. I always thought that was so stupid, it wasn't funny.
Well, we'll have to see. We'll still have to see the outcome of that. But anyway, there's also a fair story to say. He's saying one thing and doing the other thing, so we'll just have to see how that plays out. But it is, in essence, what central bankers are doing is filling the gap that politicians leave. And you can argue that's exactly the same thing that's happening in Australia. Central bankers are going way beyond their means for the simple reason that politicians are not doing their job.
Okay, so this is high-level thinking, Rudi Filapek-Vandyck style. For normal people at home saying, yeah, so what? How do I play the market?
Well, here's the thing.
Answer the question.
And those are the risks I'm about to point out. Because what we've got into the situation is we had a small group of people, bankers in some regions, that mispriced risk, and that's where we got in the mess. What we now have is that the whole wide world is now mispricing risk, and that's the problem. And how can you see how risk is mispriced? Well, dividend stocks are arguably a little bit pricey, unless you believe that interest rates will never rise in the 5 years ahead or something like that. That is still a possible scenario, but also high-yield bonds are, very much loved and bought by everyone. So I believe that if you look across the world, you have a mispricing of risk, and I do believe that probably the Federal Reserve is of the same view. But what you don't want, it's okay right now, it's not really damaging quite yet, but you don't want this to become permanent or go further, because ultimately you will get the unintended consequences, and that will be, at some point you can't stop that anymore. But anyway, what you see in this market, and that's, I think, what's happening in the market right now should make investors think a little bit, Dividend stocks are not a one-way street. And we see that right now. And I believe what's happening right now in the share market is the foreigners withdrawing from Australia.
Yeah.
I see quite a few global strategy reports, and Australia is almost every time in the bad corner. Underweight, sell, underperform.
We were the flavour of the month for a long time, so now we're not.
And that tide is turning, and that's a very important shift of dynamics we're now seeing. It's all caused by a couple of hedge funds ganging up against our dollar.
Yeah.
And all of a sudden, dynamics in the market are changing because the fall in the dollar we've seen so far equals to 25 basis points rate cut by the RBA, but the RBA hasn't done it. It's the currency done it. Yeah. Which is
going to be great for the economy.
Exactly, which has a different dynamic all of a sudden now for the share market, because now the Australian economy is getting the interest rate cuts via the currency, not via the RBA. So, conclusion number one, RBA may not cut anymore, because the currency is doing all the work. It's a possibility. If the currency falls further, I'm completely with you, all the companies that are domestically oriented or exporters that have had a really tough time, all of a sudden they get relief. Unexpected, they didn't have to do anything, it's just happening.
So the companies that have been ignored while we've rushed for dividend paying stocks, all of a sudden will start looking like good value.
Which ones in particular are you talking about? The ones that
were held
back by the currency?
You're the expert. Okay, you're the expert.
Well, the thing, you're right, but there are still, I mean, if I talk to investors, anecdotal evidence, whatever, but most of them are sitting pretty in the dividend stock area, but they have big holes in their portfolio because they have a couple of small gold miners in there, probably a couple of iron ore miners, and maybe even a few service providers, and they've just blown big holes. Even if it was...
They haven't had a well-weighted portfolio, have they?
Well,
you think about it, on your description, service
providers in Europe haven't done better than here. So, anyway, I think, in summary, what happened over the past week, I think it brings home again the message, and that comes back to risk again, that it's not about picking the winners. It's about making sure you don't have those shockers in your portfolio. And that is an assessment of risk, obviously.
But also, shouldn't we be looking at the companies who are going to benefit from a lower dollar? Because your scenario is the dollar's low, it'll probably stay low. It's going to stay low until China comes out and surprises everybody with stronger growth. We're not going to see that for a few months in best case scenario, right?
Maybe what we're seeing in China is not cyclical but structural.
Well, which
is a scenario we should all consider.
It is possible.
We should all consider.
But remember this: people are using 7.7% and ignoring what the actual size of the economy is. You know that, I know that. It's going to be commodity prices on iron ore in particular is going to be the critical factor, isn't it? That's going to be the critical factor. On the China story.
Well, no. What is going to be important for commodities, and already a process that's already happening, is not so much the growth from China. That's becoming less and less important. What is important are the constraints or not on the supply side, and you see that with all the commodities playing out now.
Okay, so should people be saying dollar down? Let's have a look at the companies who would benefit from that. For example, QBE was up a long way today. That must be on the strength of the greenback getting better, and they earn all their money in greenbacks nowadays.
Yeah, but it's the wrong response. QBE is a leverage on US bond yields, and they move up, so you should actually buy QBE for the bond yields. If you believe that bond yields in the US will normalize at some point,
I suppose they have to one day.
Then exactly at that point in time, QBE will be the buy of the century.
Okay.
But in general, what we are facing in the market, and that's where the risk is, we have a weak domestic economy, we have a global economy which is also going through a weaker phase. We have share prices that in a lot of cases are bid up, and we have this period, which might be 6 or 9 months, where earnings may not be there quite yet. And then obviously you have to be careful, because if you buy companies that have to come out with a profit warning, they can burn a hole in your portfolio.
Come on, Rudi, give us a break. Give us a stock you like. You're waxed on about all this crap about risk. Give us one stock that looks good from or looks bad.
No. I mean, I've spoken 4 years about Amcor, and Amcor is still a beneficiary.
You still like Amcor?
Absolutely.
That's the one we'll put.
Absolutely.
We'll call it the Rudi Filapek-Vandyck Destroyer. Amcor.
There you go.
Thanks, mate. See you in a couple of weeks.
My pleasure.